So, welcome everyone this morning, and thank you for joining us again for this collaboration between Hawsons and the Bank of England. I'm Pete Wilmer, Senior Partner for the firm, and delighted to be hosting Paul Mount again as our guest from the Bank of England. Paul's very kindly given up his time many years now to co-host this seminar for us. So delighted to be joined by him. Um, I was just mentioning to Paul earlier on this morning that earlier this week I was reading an article and it spoke about the relentless volatility that we've witnessed and been party to since probably really sort of COVID and 2020. It just feels like it's really sort of been one thing after another. But I thought that was quite a neat way of summing it up, this relentless volatility. It certainly feels like that. And I think when we speak to our clients, business owners, I think genuinely that's a sentiment that will resonate with them, that it absolutely feels that way. So the challenges seem to continue. But hopefully Paul will be able to help us kind of make sense a little bit of some of that history that we've been through, what we're experiencing right now, and what that might mean from an economic perspective over the months to come. So without further ado, if I can, Paul, I'll sort of hand over to you and allow you to begin proceedings.
Lovely. Thanks, Pete. Thanks for inviting me to speak, and thanks for everyone for tuning in. So, I let me just move the slides on. There's just a bit of a lag on this, I think, so it might just take a second. Just bear with me. There we go. There we go. It should work fine now. I'm going to speak probably for about 20 to 25 minutes. I'll say a little bit about myself, a bit about the bank, but then I'm going to focus on our latest economic report and just try and give you some insights into how our interest rate setters are thinking about the economic situation at the moment, what that might mean for interest rates and the economy. So I work in the bank's agency network, previously in Yorkshire and Humber, but I've just switched over to the East Midlands. The role is pretty much the same. So the key part of the role of the agency network, 12 agencies across the UK, is to engage with business leaders like yourselves to understand what's really going on in the economy. We theme that sort of data across information across the whole country, and we feed that in to our interest rate setters at the bank, so they've got a well-informed picture of how businesses see the economy. We're going to do a couple of polls now, I think. So I'm going to move it on to the first one. So the first one is just to see who's on the call. And I think Robert at Hawsons is going to launch this, so you can just respond and we can see what sort of range of businesses we've got. Okay, so the results are in. It's probably not a big surprise that we've got lots of people from sort of professional financial business services, got some from construction, manufacturing as well. So I expect that also to some extent reflects the makeup of the Sheffield and sort of Northampton economy. So that's great. Okay, thank you. So I think we're doing another one now. So I'll try and move the slides on. There we go. We're going to ask you about sort of job role. So if you could fill that one in when it launches. On my screen, Robert, that one's not actually come up as a poll as yet.
Yeah, sorry, I'm struggling to launch this one, so we might have to move on if that's okay.
Yeah, no, okay, we'll move on. Brilliant. There we go. Okay, so just very briefly, a reminder of the bank's role in the economy. We're part of the public sector essentially, but we operate independently from government, but we are ultimately accountable to the public via Parliament. And our mission, we have a dual mission around maintaining monetary and financial stability. The agencies very much feed into the monetary stability part, which is all about sort of low and stable inflation, and that's the part of the bank's work that I'm going to be focusing on today. So just a sort of reminder of what inflation is, what monetary stability means. So the government asked the bank to focus on keeping inflation sort of low and stable, and that's really seeing a sort of low and stable inflation as the foundation of a strong economy. It helps households and businesses plan for the future with a degree of certainty, and the economic sort of literature or orthodoxy, I suppose, is seen, is very much seen as a real foundation of sort of strength in the economy. So the government sets the bank an inflation target that's based on a measure of inflation called Consumer Price Index, or CPI. And the general idea is that we aim to keep that at 2%. The target's symmetric, so we don't want sort of high inflation, but we don't want inflation getting towards zero or even negative, because then the economy sort of is at risk of recession. CPI, it's a national statistic. It's based on a sort of typical or average household spending, so a basket of goods. So, for example, food is about 12% of the index. The table at the bottom is just making the point that CPI is the change in the general price level. So really just looking at the table, you can see you can have some very big increases in inflation in 1 year, so the inflation rate goes to 10%. But actually, if those prices just stay the same a year later, the price level's permanently higher, but inflation has gone back to zero. So it's just making that point that it's a measurement of change. So how can the Bank of England influence inflation? I mean, I think the key thing to think about here is that we only have one lever of economic policy at our disposal, and that's bank rate. Bank rate is the key short-term interest rate in the economy, and when the bank changes bank rate, that very quickly feeds into the savings and loan rates that you as household and businesses will face in financial markets. Changes in bank rate will feed into those interest rates, and that will influence household consumption and business investment. So that will influence activity in the economy. And after a period of time, activity will start to feed through into inflationary pressure. So, for example, if the bank's increasing bank rate, that would increase interest rates of the economy. The idea would be that household consumption and business investment would moderate to some extent, and we'd therefore expect sort of less inflationary pressure. In the sense that demand would be weaker relative to supply. So it's all about really sort of short-term demand management. The key thing we have to think about is that there are time lags between changes to bank rate and economic activity and ultimately inflation. It doesn't just happen overnight, and it can take up to 2 years for a change in interest rate today to feed through fully into the economy. The bank's remit recognises that the actual inflation rate will depart from target as shocks hit the economy. We've had plenty of shocks in recent years, and of course inflation has deviated from target at times quite significantly. And again, there's something in the sort of final bullet there. There's something that's directly, more or less direct from the remit that says, the remit from government recognises that we can't keep inflation at target at all times because of undesirable volatility in output. So we're always trying to sort of look ahead and think, well, how do we get inflation to target in a sort of sustainable way? And this is all very relevant, I think, for thinking about energy shocks, which I'll come on to. Very briefly on the process for setting the interest rate. So we have something called the Monetary Policy Committee. There's 9 independent members on that committee who each vote. They vote independently to set the interest rate 8 times a year. And 4 times a year, that decision is informed by a UK economic forecast that we publish. And before all of those 8 meetings, there's a very in-depth series of sort of in-house meetings that the committee will go through with staff from the bank. And they're sort of bombarded with data from various teams, forecast scenarios, information from the agents about what businesses are telling us. So they make that decision with a large amount of sort of up-to-date information. Right, so don't get too excited about this one, because this is actually looking back to our forecast in February, which actually had quite a sort of nice picture of the economy moving forward, really. But I want to just briefly touch on this one because clearly things have changed with the Middle East, and it just sets the context. So back in February, when we produced the forecast, we actually thought CPI inflation would be back to target in April, so about 2%. Now the actual figure was 2.8%. Largely driven by increases in fuel prices since the Middle East conflict. We also had a sort of forecast that was showing GDP gradually improving, so GDP real output growth, largely based on an assumed recovery in consumer spending, and unemployment fairly sort of unchanged at around 5%, which is pretty low in historical terms, but is higher, than it was sort of after COVID and Russia-Ukraine. Some key assumptions in that forecast. So we always take fiscal policy as given. We always assume in our forecast that bank rate follows the market curve. So what financial markets are pricing in for bank rate, and probably most significantly is highlighted that there's no further significant shocks to the economy. So we've now had, of course, a very significant shock to the economy. Disruption in the Middle East. So second bullet, CPI inflation was 3.3% in March. It was then 2.8% in April. And we think it will remain higher in the coming months, higher than target, sort of 3% plus, largely driven by the initial increases in sort of petrol prices, firm costs, and also there'll be an increase in household energy bills from July. So household energy bills are calculated with something of a lag based on energy input costs, but those will start to increase. Those will increase in July. So monetary policy can't undo the increase in global energy prices. We know it takes time for monetary policy to work through the economy. So there's no way that the MPC, the Monetary Policy Committee, could act now to sort of reduce inflation. But what I'll come on to is talk about the concerns around sort of second round effects and actually what we might be thinking about in terms of interest rates as an institution. And we also make the point that financial conditions have already tightened. So financial markets now expect the bank to increase interest rates by 2/4 percentage points by the end of this year. That's as of this morning. Whereas actually when we did the forecast in February, there was an expectation in financial markets that we would be reducing the bank rate by the end of the year. And that particularly feeds into the rate that people can get on sort of fixed term mortgages, because those are priced off the market curve. This figure is just showing really just showing that point. It's got lots of different rates on from different areas, but the aqua line, the aqua solid line, is the UK market path for bank rate as of the end of April when we did the forecast, and actually it hasn't changed that much since the end of April. So at that point, financial markets were pricing in a 0.5 percentage point increase in bank rate by the end of the year because of the inflationary impact of the Middle East crisis, and I'll come on to say a bit more about that in a second. So the problem with energy shocks is that they increase inflation, but they also tend to reduce activity. So this figure is really just in a very sort of simplified way, just saying, well, actually, what are the effects of an energy shock on the economy? Just remember that the UK is a net importer of energy, so this is effectively a sort of import price shock. So we have some direct effects through higher fuel prices and household utility bills. So those will tend to increase inflation. Some indirect effects in the sense that businesses will see higher costs, so they'll see higher energy costs, but also energy intensive materials like steel and plastics are already increasing in price. What worries us most, I suppose, as a central bank in terms of the inflationary impact of an energy price shock is what we call second round effects. And this is where effectively those direct effects are seen by households and firms and then could feed through into higher wages. So households see the risk of their real incomes decreasing, so they try to bid up their wages. Firms see higher costs coming through, so they look to increase their prices in expectations of those higher costs. And in various parts of the literature, we might talk about that as a sort of wage price spiral, and it can be reinforcing in a sense. So that's a concern. On the opposite side, though, we do have real income effects. So people will have less money to spend on other things because they're spending more on energy, fuel, and household energy bills. So that might actually loosen inflationary pressure in the economy. So there's a sort of balance of effects. So in the report we published in April, we said a little bit about second round effects. So this was in something in Key Policy Judgment 1. And I think the general message there was that second round effects wouldn't be as great as they were after the Russia-Ukraine energy price shock. And that was broadly because the labour market's considerably weaker than it was then. Unemployment's higher, wage pressure is less, and also consumer demand is weaker. So if you think back to sort of spring of 2022, we were very much coming out of COVID. The economy was sort of increasing, demand was increasing. There was a lot of labour shortages. So it's a different situation now. But what we have said, which I suppose is sort of obvious, is that second round effects will be stronger. The longer lasting is the conflict and the effect on global energy prices. So the second key policy judgment, or the second key point that we sort of made in April, was essentially that, I suppose, the second round effects in terms of higher wages or higher firms' prices, we may need to balance the cost of leaning against them too little, and then inflation increasing and those expectations becoming embedded. So we talk about sort of inflation expectations becoming de-anchored, the bank losing credibility in its inflation fight and therefore having to raise rates more later on because inflationary expectations have become embedded, versus the sort of the risk of overreacting, raising rates, and then ending up with a very weak economy perhaps in a couple of years and inflation actually going below target or even to zero. So there's a balance to be thought about there. In the April decision, the committee viewed that bank rate at 3.75%, so unchanged, was the appropriate rate to balance those risks. But that might change over time as things unfold. And I'll talk a bit more in a minute about some of the scenarios and so on, and some of the things that people are looking at in terms of thinking about the extent to which second round effects might evolve. What I think is important to say is that if we don't act now or fairly soon, and there are second round effects later on, it will sort of be too late because interest rates take time to work through the economy, and we've got those transmission lags. So that's the sort of those are the sort of factors we're trying to balance. Just to set a bit of context, at the moment, some of the survey-based evidence suggests that in response to the shock, firms aren't necessarily seeing increased wage pressure, and that might partly be because a lot of them have already settled for 2026 in January or April. Most firms tend to settle then. But they are expecting their own prices to increase more than they were previously. That's shown at the sort of the increase in the aqua line at the end, and that's clearly reflecting their expectations of higher costs and higher inflation. Labour market conditions, I said already, are much looser than 2022. This chart's really just showing that. I won't go through all the measures, but the one on the left is showing the vacancy to unemployment ratio. So it's the number of vacancies in the economy versus the number of people unemployed. You can see at sort of time around just after COVID that actually there were more vacancies in the economy than unemployed people, but that's come down very significantly. It's very significantly in the last couple of years. And the latest data show that the number of vacancies in the economy is very weak. So a much weaker labour market than in sort of 2022, the last big energy shock. So I'm going to move on to talk about some scenarios that we published in the report in April. The bank usually publishes a sort of central case forecast that it sees as a most likely forecast. But in April, because of the heightened uncertainty and volatility, we actually moved to doing scenarios rather than a central case forecast. I think the last time we did that actually was when COVID hit the economy. So it is quite unusual. But let me just broadly talk through the three scenarios we published. Clearly, there's a sort of infinite number of scenarios that you could look at, but these are meant to be illustrative and show different sort of ways the economy might react. So on the left-hand side, we've got the dollar price of crude oil, and we've got how that might develop in three scenarios over the forecast horizon. So we forecast out for 3 years. So scenario A has got a sort of short shock with the oil price returning to a sort of more normal level reasonably quickly. Scenario C is a sort of worst case scenario where the oil price actually increases from where it is today and then comes back down, but not to the level it was pre the shock. And scenario B is a sort of in between best case and worst case scenario, essentially around the oil price. And similarly on the right hand side, the same for the natural gas price. And just to sort of stress that the price of natural gas is particularly important for the UK because we use a lot of natural gas in household energy, and it's also the sort of marginal energy source for electricity as well. So it has a big impact on electricity prices. Again, the same three scenarios. The gas price, comes down fairly quickly in scenario A, but in that worst case scenario C, it heightens from here and then only comes down gradually. So that's thinking about the energy prices in the scenarios. And let me just move on a slide. And we can see what the impact on inflation and sort of activity is in those three scenarios. What I should have said as well in the three scenarios, in scenario A, we have no second round effects. Scenario C has quite significant second round effects. So we assume there that households are able to bid up wages, firms push up their prices, and scenario B is a sort of middle case. And you can see what that means for inflation. So in scenario A, well, in all scenarios, the immediate impact is that inflation's above target. In scenario C, that worst case scenario, inflation increases quite quickly, gets up to about sort of just over 6% at the end of 2026 and gradually comes back. But actually, by the end of the forecast horizon, by the end of 2020, well, Q2 29, actually is still above target. Scenario A, inflation comes back to target quite quickly, and actually by the end of the forecast horizon is below target, and scenario B somewhat in between. Now, what I would always stress is that these forecasts assume that bank rate follows the market curve. So we don't sort of put in our own estimates of what the interest rate might be into the forecasting models. We just use the market curve. So all these scenarios and the predictions for inflation and on the right hand side activity assume roughly a sort of 50 basis points, half a percentage point increase in bank rate, because that's what the market curve was showing prior to the forecast. I'm not going to talk too much about the output gap slide on the right hand side, but that's basically showing there's a bigger hit to output under scenario C than there is under scenario A. So scenario C is very much the sort of worst case forecast. Let me say then a bit about what next for bank rates. So this is the really tricky bit. So the Monetary Policy Committee, will be very focused on second round effects. So they will be looking for evidence that firms are raising prices, or that firms are giving in to sort of higher wage demands and the wages are increasing. What we're worried about is in the sense that inflationary pressures become embedded. I talked about that idea of wage price spirals, and therefore, you need higher interest rates further out to actually bring inflation expectations back to something that's consistent with target. I've already mentioned that in April, we stayed at 3.75%. The next decision is in a couple of weeks in June. So I think on Monday the meetings for that decision will start up, and the committee will be looking at the sort of new information that's available. I think probably the bottom bullet is the key one, that the bank is never going to commit to a predetermined path of interest rates. We always try and give a steer as to where they might go. I think at the moment that's particularly difficult, and there are different views, I think, on the committee about the balance of risks of a wage price spiral due to second round effects, or the risk that further out demand is weak and actually inflation falls below target. But that's sort of where we are at the moment. Let me just move us on another one if I can. Okay, so we're going to do a couple of polls now, just to sort of wrap up before we move into Q&A. So interested in the outlook for your business on investment, because this can be, a lot of firms have already been telling us, I think, that because of the uncertainty, they're looking to sort of cut back on investment. So it would be interesting to see what those of you on the call are thinking at the moment. Okay, so that's fairly balanced, interestingly. So it's good to see that some of you out there are still looking to increase investment. Most at the moment are saying sort of broadly unchanged, and maybe to some extent that this sort of reflects that it's still not clear where we're going. So we've got another poll, I think, coming, which is around employment intentions. Again, I guess a risk of a shock is that people start to sort of pull back on employment. So let's see what those of you on the call are thinking around headcount over the next 12 months. Okay, that's interesting, because there's more of you looking actually to increase employment. So that's reassuring. We must have some businesses on the line who are still looking to grow over the year ahead. So that is interesting, because that's probably slightly more optimistic than I think we're finding with the sort of general population of businesses across the country. So look, that's really helpful to set some context. I think we're going to move on to some questions and discussions. So it would be good to hear from you, what you made of that, but also any questions you've got for me.
Yeah, thanks very much, Paul. Insightful as always, and I suppose just for everyone's benefit, I appreciate people sort of participating in those polls. I know from your perspective, Paul, it helps give you some sort of direct sort of insight into the sentiment of what people are business leaders are sort of feeling right now, and that's really useful information from your perspective to be able to feed back into the bank when you're kind of considering, the implications of what we're seeing right now and the effects that might have over the coming months. So thank you everyone for participating in that. So, as Paul's alluded to, we do have some time now for some questions and answers. So, our opportunity to put Paul a little bit on the spot. So, thank you very much for opening yourself up to that. Hopefully, at the bottom of people's screens, you will see the Q&A function there. So, please do feel free to pop your questions into there. We have had one already. We had a few in advance from some of the participants, Paul. So, we'll kick off with the first one that's come into the box, if that's okay. And just to reiterate to everyone listening, please do fire your questions into there and I'll pick them up and put them to Paul as we go through. So first off, from one of the participants today is just really around, I suppose, some of the concerns that we are sort of seeing, that perhaps feeding into the likelihood or possibility at least of a recession at some point over the next sort of 12 to 24 months. I suppose, two-pronged really. How likely perhaps is the Bank of England kind of seeing a sort of recession right now, and also how concerned would the bank be about the UK economy going into recession?
Yeah, thanks, Pete. I mean, I think it's very difficult to give sort of probabilities at the moment, because we're in such a period of uncertainty. I think in none of the scenarios do we actually, even in scenario C, do we actually predict, or would that scenario wouldn't suggest a recession? So a recession being technically being sort of two negative quarters of growth. I mean, I think if we think of recession perhaps as a more generic term, around a very weak economy with potentially output sort of flatlining, or saying broadly stable. I think there is clearly a risk of that, and I think that is definitely on the minds of our policymakers, because in that sort of scenario, you would have a risk that inflation would potentially be negative, that could reinforce very low output, or could lead to falling output because of people will spend less today if they think things will be cheaper tomorrow. So in the sense that a recession on the other side of that is very, very weak inflation. If that was coming through, the bank would act, because our objective is to try to get inflation to 2% over the medium term. So a recession, is a concern to the bank, and we'll be keeping a very close eye on how that's developing. And that is one of the key roles of the agency network, that we can give a bit of insight to the interest rate setters before the data comes out about how firms are feeling, and how the economy is developing.
Okay, thank you, Paul. One of the questions that we'd sort of received in advance probably sort of predates, does predate obviously your presentation. I think it was interesting to hear, obviously now that there is really probably quite a significant shift in terms of the bank's outlook in terms of rates, as you alluded to, perhaps earlier on this year, expectations of some modest reductions to rates over the remainder of 2026, but now really a sort of complete sort of reversal to that, and actually expecting some increases. So I mean, the question itself was actually about the fact that we have seen a persistent overshoot in inflation, and sort of leading into this presentation, obviously the fact that we had seen some reductions to rates, and that expectation of some further rates. I suppose, well, the question remains valid. Why perhaps in an arena, a scenario where we are seeing a persistent overshoot in inflation, might the bank choose to still be contemplating cutting rates?
Yeah, I mean, I think this is an interesting question. So we cut rates before inflation was at target, and I think it relates back to what I sort of did allude to briefly at the beginning, which is monetary policy works with a lag. It can take 18 months to 2 years for the full effect to come through. So we did start cutting rates. Rates peaked at 5.25%, and we did start cutting rates before inflation was back to target, but it was clearly on a downward trend. So we talked a lot, before the Middle East conflict about the disinflationary process. So this was looking at underlying drivers of inflation. Actually, were wage bargaining, were wage pressures coming down, were firms cost increases coming down, and the general sort of sense was that yes, they were. Wage inflation had come down a lot. So we cut rates, I suppose, in expectation that disinflationary process would continue. As I said again at the beginning, we had previously forecast in February that inflation would actually be at target in April of this year, which because it now isn't because of the shock. And I suppose in a sense, it's very much a story of shocks hitting the economy. The bank can only set interest rates with the information that it has at hand at the time of the decision. What we can do, though, is when a large shock hits the economy, we can clearly change the outlook or change the discussion internally about what rate is needed to keep inflation at target. And that is sort of where we are now, I suppose, that actually that discussion has moved on quite significantly in terms of thinking about, well, what's the appropriate rate to anchor inflation expectations, maintain the credibility of the central bank as an institution, and keep inflation at target. But this is the challenge, I suppose, in a world where there's a lot of uncertainty and a lot of volatility. You can't predict the shocks that hit. So, I mean, that in a way is the driver, I suppose.
Yeah, indeed. Yeah, I think a pretty unenviable task on the bank there in terms of trying to
It's
respond
it's
to
it's
all
a
this.
difficult job, Pete, I would say, but there's clearly far more difficult jobs, right? And one of them, in my view, would be running a business. So it is a difficult job, but not the world's most difficult job by any means.
Okay. So a question that's come through live this morning, but also was posted in advance, actually, is a similar sort of topic. So inevitably, you can't go very far these days without AI creeping into the conversation. Obviously, from the polls, interesting kind of insight that actually, a lot of our participants this morning are kind of expecting there to be some degree of increase to their headcount, which is perhaps slightly kind of counter to a lot of what we're hearing and the impact that AI may have on the workplace and our working practices. But from kind of your perspective, the bank perspectives, what's the sentiment right now around kind of AI, the potential impact that it could have, how that could feed into unemployment? Are there concerns, or is it a sort of positive outlook from the bank that actually, it could be really beneficial to productivity?
Yeah, I think there's a bit of both. I think, there's clearly a possibility of some short-term disruption to job roles. I think it's fair to say that we do hear more firms thinking quite seriously about how they might deploy AI to limit increasing employment. So we're not seeing many firms saying that they're planning sort of large scale redundancy programs, but we do often hear from firms that, if someone's left the business, that they're thinking harder than they might have done before about whether they replace them. And one of the things they might say is that actually we are looking at ways that we might deploy AI a bit quicker, in order to maybe rearrange the existing staff's roles and actually use AI a bit more, and maybe we don't need to increase headcount. So it's definitely happening. There are long-term potential productivity gains. That's very clear, I think, in the amount of investment globally that's going into AI. Financial markets clearly think that it's something that is going to sort of change the way the world works over time. In terms of the sort of employment implications, I think that again is hard to say. It's clear, I think, for some of the discussions we have, that there are certain roles. There will be fewer of those roles in future. It tends to be sort of back office, administrative, data input type roles. But I think, I'm old enough to remember sort of when digital technology was really rolled out. There was not such a role as a digital marketeer when I graduated or I was young. Whereas now, there's lots of digital marketing roles advertised, and my son's interested in digital marketing. He's just graduated with a sports marketing degree. So I think, yeah, some jobs may disappear, but some jobs that we probably can't even imagine yet will I'm sure appear. So it's very hard to know what the overall impact on the labour force will be, I think. But the hope is that AI does lead to productivity gains, and it gives us, after a very weak period of weak productivity, that it gives, I think, a bit like the rollout of digital in the sort of 90s, early 2000s, it gives a bit of a push to productivity. But I think it's a case of watch this space. There is some interesting stuff on. I mean, there's lots of interesting stuff on this in all sorts of organisations, but the bank has published some stuff about AI. I think if you Google Bank Underground, Bank of England, if you just Google Bank Underground, you'll get Bank Tube Station in London. But we have a sort of thing called Bank Underground where we publish some of the staff analysis, and there is a good piece within the last year on some of the labour market possible implications, and there's lots of stuff on it, I guess, but I don't think there's a consensus yet on where that will go.
Yeah, definitely. Lots of potential kind of scenarios and impacts clearly that could arise. So we'll all be interested to see how that sort of plays out. I mean, something you touched on just as you were sort of answering that one, Paul, was around sort of equity markets, and one of the questions that we've had in focus is in on that a little bit. So I suppose I will start off by sort of saying that none of this is going to be investment advice or should be taken as such, but obviously we are, despite all the kind of shocks and challenges that we're seeing in the economy, in the face of that, equity markets are continuing to perform extremely well. So is there any kind of view from the bank in terms of what might be still kind of continuing to support those equity markets at such high valuations, and is there any anticipation of perhaps some degree of correction there?
Yeah, it's an interesting question. I think the other side of the bank around financial stability, I think we have made some sort of comments around financial markets. There's been some comments in the financial stability report that was from, let me try and think where we are. I think it was probably from December last year, about risks in very high valuations in tech stocks and so on. So I think there is some recognition that perhaps suggests a vulnerability. If stock markets are running pretty hot, then we know there's a chance of a correction, and I think that's particularly true probably in sort of tech stocks, in AI stocks. We saw that in sort of early 2000 around the sort of correction in telecoms and internet type stocks. So there is perhaps a heightened risk of that, and we have said some stuff about that publicly. I can't quite remember exactly what we said, but there is a financial stability report from December, which I think will have some stuff on that. And I think our Deputy Governor, Sarah Breeden, has made some public pronouncements on that as well. So it might be worth looking up some of Sarah's comments. But it is something, I mean, from the monetary policy side that the bank thinks about, but particularly from our role in trying to maintain financial stability, it's clearly something that we keep a close eye on.
Yeah, sure. And just, I suppose, just briefly kind of going back to that point around sort of AI, one of the questions that we've had in is, how is the Bank of England itself, sort of making use of AI right now? And is that sort of feeding into any kind of the forecasting and modeling work that the bank does?
Yeah, I can tell you a bit from the agency's perspective. I mean, I think we're like a lot of organisations. We are using it a lot more, and there's been a lot of work to develop tools and to train people in how to use it. So, I give an example from our network. We collect a lot of data, a lot of qualitative data from businesses, and we write that up, and then we try and pull out some themes for the committee about what businesses are telling us. And we've developed a sort of in-house AI tool which can analyze those write-ups, and you can ask it a question and it will tell you what it thinks the outlook for food inflation is, or what's demand like in the hospitality sector. It's in my experience, it's useful if you want to answer things quickly. You've got to use it with a degree of caution, and I think that's probably reflected in a lot of the feedback I get from firms about how they're using AI. So I think at the bank, we are like a lot of businesses. We are starting to use it. We're using it cautiously with the human in the loop. I don't know exactly how it's being used in the forecasting world, but my sort of intuition. I'm not an expert statistician, econometrician, but I would guess that there's the potential to use it quite a lot in the sort of forecasting world as it develops. So I'd be very surprised if we weren't embedding some sort of AI or at least thinking about how to use AI more in the forecasts.
Yeah, sure, sure. And obviously, from the Bank of England's perspective, then there's kind of two in particular real sort of key tools that you always have at your disposal in terms of influencing the sort of economy. Obviously, interest rates is one, but quantitative easing is the other. We've spoken predominantly sort of around sort of the interest rate outlook right now, but one of our participants today is keen to understand if whether there's perhaps any sort of views, considerations around a QE program right now.
So where do I start with that? I mean, the first thing to say, is there any discussion in the committee about using QE? I don't know because I don't sit in those discussions. What I can say, I think, is that if you look back on when the banks used QE or quantitative easing, maybe not everyone is familiar with the term. So this is where the bank essentially swaps government bonds for cash. So it creates cash, and it's really a sort of liquidity boost to the economy. So we buy government bonds in secondary markets, not directly from the Treasury, but in secondary markets. So bonds that are typically owned by pension funds or insurance companies, and we take those bonds onto our balance sheet and we swap those for cash essentially. So it increases liquidity in the system. We've only really used quantitative easing, I think, at times of significant stress on the economy. So if you think we used it first after the financial crisis, we used it when Brexit hit the economy, and we used it when the pandemic hit. And I think I'm right in saying we also, when Russia's invasion of Ukraine, there was more quantitative easing. Is the conflict now on the scale of those shocks to the economy? I'd say probably not. We do actually have a program now where we're actually doing something called quantitative tightening. So we're selling those bonds back to pension funds and insurance companies on a very transparent sort of profile to try and, in a sense, run down the number of government bonds, the amount of government bonds, the value of government bonds we have on the balance sheet. And the idea there really is that if there is another really big significant shock to the economy, we want to have some scope on the balance sheet to be able to perhaps do a quantitative easing program if the need was there. My best guess would be that this shock isn't currently at the amplitude that you'd be thinking about quantitative easing, but because I'm not sat on the Monetary Policy Committee, so I wouldn't be hearing those discussions. But my best guess is not. We are currently still selling bonds back.
Yeah, thanks, Paul. Yeah, no, look, and appreciate you offering, except as a personal opinion there, but offering that up in any case. Just one, I suppose, point of housekeeping really, as we still have a couple more questions that we want to try and sort of get through this morning. Yeah. But can I just clarify, one or two people have inquired as to whether they could have a copy of the slides that you've presented this morning, Paul. Is that going to be okay?
Yes, they can. There's nothing. Yeah, I'm sorry to tell you that there's nothing not public on the slides. They're all in the public domain. So I mean, Pete, you and Robert can send them out to all participants or anyone who requests them. Absolutely.
Well, what I'll perhaps ask then, if anyone is in particular sort of interested in receiving the slides from this morning, then do just message through to Rob Carr. So Rob, hopefully you don't mind me volunteering you for that task. But if you do so, then Rob will make sure you get a copy of the slides after the event. One again sort of question that we've had through this morning, and I think this kind of goes in large part to the relationship between the bank and sort of central government. Obviously the bank is independent of the government, but the question itself is talking about whether there is effectively any pressure from the bank towards government, I suppose, to try and make your jobs a little bit easier, ultimately to sort of say, look, if things like national insurance rates, income taxes were sort of reduced in any way, maybe that would sort of ease some of the wage pressure that clearly then ultimately then does feed into concerns around inflation and makes your job a little bit more challenging in terms of responding to the inflation as we see it. So probably it's perhaps a good opportunity just to talk a little bit sort of generally about that relationship between the bank and the government.
Yeah, I mean, I suppose there's oh, what's going on there? I was getting a bit of an echo there. I think it's gone now. Okay. I suppose there's two things there. I mean, one is just thinking very generally about sort of fiscal policy that the government controls and the bank control the monetary policy, the interest rate. Um, Clearly, they're connected, and I think you'd expect that the bank and the treasury are talking pretty regularly, or the government are talking pretty regularly about the economic policy mix, and they are. We have good relationships with treasury at staff level, and I know that the senior team at the bank, the governor, the deputy governors, have good relationships with the senior politicians in the treasury, so the chancellor and so on. There's a good reason, I suppose, for the interest rate decision to be independent. I mean, those of you who are old enough will remember the 70s and 80s when governments controlled interest rates and fiscal policy, and you would typically get sort of boom bust cycles were more common, and that was true across the globe. And in a sense, that was why independent central banks started to emerge in the 1980s, with the central bank effectively being in charge of interest rates. So I don't feel that there's any sort of risk to independence in global economies in terms of central banks. But it's true that big changes to fiscal policy will change the outlook for interest rates. In a sense, the Bank of England aren't. We're not the ones who are elected by the public, so we just have to deal with that as it comes. I think that's right and proper that the government sets fiscal policy. The government in any economy sets fiscal policy. They set it as they want to. They can change their minds, and it's our role to respond with the appropriate interest rate to get inflation to target. And that's true for the Bank of England. It's true for the Fed in America. It's true for the European Central Bank or any other central bank.
Yeah, thanks, Paul. I suppose it sort of segues into another question that we'd had this morning, and this may again perhaps be a little bit more of a sort of personal opinion than a bank opinion on this occasion. But clearly, fiscal drag has been a factor that's been going on for sort of many years now. And do you have any sort of thoughts or opinions on perhaps how that might be sort of impacting on general sort of economic growth?
So let's just check what fiscal drag is, Pete, because people see this. So my understanding of fiscal drag is that we're talking about people being pulled into higher rate tax bands. Is that correct?
Well, I think knowing that the question came from someone that's particularly interested in sort of tax and tax policy, then I do suspect
Yeah.
that's exactly what they're referring to. Yeah.
Yeah. I mean, and I think we. Again, I'm not going to give a personal view, but if you go back to economics sort of 101, if the government's taxing more and taking money out of the economy and consumers have less money to spend, it depends on how the government's spending the money, but you'd probably think that will lead to less spending overall in the economy. I think. I mean, you in a sense you're taking money from consumers, and the government's spending it on their behalf, possibly, or maybe they've got a higher debt burden. I think so. I think it depends. It depends how that money's being spent, what the impact is on growth, and ultimately what the impact would be on inflation. But I guess generally, you would think that it's probably leading to weaker growth. So all the things equal, you might see lower interest rates because inflation is weaker. It does depend how the government's spending the money, though, I think. So it's not an easy question to answer.
Sure. Well, I think in terms just looking at the sort of time there, then Paul, I appreciate we've landed you with a tricky one at the end there to finish
Yeah,
on.
very
But,
tricky.
but
I think I
thank
dodged
you
it.
as always. Thank you for all your efforts in trying to give us some useful sort of insights. And let's face it, kind of table what are very challenging subjects and difficult things to comprehend at times, and trying to distill them into a manner that is more accessible and usable for us all. So I hope everyone on the webinar this morning has enjoyed that and gained some useful kind of insights from Paul. As we mentioned before, so the slides can be made available. So either reach out to Rob Carr or your usual Hawsons contact, and we will make sure those find their way through to them. And again, thank you to all our participants this morning for providing some insights through to Paul that he can make use of in his day-to-day work. Paul, any final sort of thoughts or reflections from you?
No, I think that's been hugely helpful, Pete. These events are important to us because it helps us get the message out. It helps us, hear back from business as well. So, I'm really keen to keep a sort of two-way communication going. I know you're one of our business contacts. Pete, your office in Northampton is as well. I'm sure some of the people on the call are business contacts. So it's possible. I think you might be able to share at least the names and organisations of people on the call. If I can see those, and we've got any gaps in our coverage of people we speak to, I might reach out on LinkedIn to specific people. So if I do reach out to you, please try and respond positively, although I appreciate that you're all very busy people, I'm sure. But look, thanks for joining the call, and I'll look forward to the next one, Pete.
Yeah, super. Thanks very much, Paul, and thank you everybody for joining us this morning. We'll bring things to a close there. Thanks very much. Bye.
Cheers, Pete. Thank you.